Bom dia. Primeiramente, gostaria de agradecer a presença de todos em nossa segunda Global Manager Conference, desta vez em formato online. O tema de hoje será como encontrar valor nos mercados globais. E para nos ajudar nesse tema, teremos a presença de Barnaby Wiener, Senior Portfolio Manager da MFS. Wiener é diretor de investimentos e gestor das carteiras de ações, além de ser responsável pela parte de sustentabilidade e administração da MFS. Desde o lançamento do primeiro fundo de investimento aberto nos Estados Unidos em 1924, a MFS tem se comprometido com um único propósito: criar valor alocando capital de forma responsável para seus clientes. Em uma parceria de exclusividade com o BTG, a MFS oferece ao investidor brasileiro a oportunidade de investir no MFS Prudent Capital, um fundo multimercado de retorno absoluto que investe em ações e títulos de crédito globais. Até junho desse ano, o fundo acumula rentabilidade positiva de mais de 4% e desde seu início em dezembro de 2018, mais de 17%, superando assim o CDI em mais de 220%. Junto com o Wiener, teremos a presença de Untitled Chapter, Senior Portfolio Manager da Rubico. Untitled é responsável pelas estratégias globais, emergentes e de renda. Na Rubico, a pesquisa está no centro de tudo que eles fazem, com uma abordagem pioneira e cautelosa, que está em seu DNA desde sua fundação em Roterdã, Holanda, em 1929. Também com uma parceria de exclusividade com o BTG, a Rubico oferece ao investidor brasileiro o Rubico Global Credits, um fundo de crédito global com excelente histórico de retornos. Até junho desse ano, o fundo acumula rentabilidade positiva de mais de 2% e desde seu início, em junho de 2018, mais de 25%, superando assim o CDI em mais de 215%. Hoje, para moderar essa live, teremos a presença de Renato Mimica, CIO da revista Exame. Mais uma vez, muito obrigado, e agora passo a palavra para você, Mimica, logo após o vídeo das gestoras.
There are several aspects to the philosophy. If I were to sort of highlight the key elements, so we're not worried about how the market as a whole performs. We're worried about how our capital performs. We also have a very long time frame. We believe that ultimately the biggest opportunities in investing come from being more patient than your peers, and I think that's probably always been the case, but is especially the case nowadays, where we're all suffering from information overload, where holding periods are as low as they've ever been. So having that discipline and also luxury of being able to take a long-term view, I think is a really important part of the philosophy. I guess the other thing I'd say is that just keeping it very simple. I think investing is one of those things that can be made more complex than it need be. And maybe there are complex investment strategies that are very successful, and they're probably run by far smarter people than me. But we believe that just keeping it simple and sticking to companies that you feel confident in and being disciplined about valuation is the right way of managing money.
Hello, my name is Victor Verberg. I'm leading the global credit team at Rubico. Sorry, I can't be at your event. It would have been a privilege, but in current days it's just not possible to travel that distance. The video only lasts 90 seconds, so let's come to the point. We believe the rules have changed in fighting the common enemy. The common enemy, of course, being COVID-19. The rules have changed mean we are facing very weak economies, supported by fiscal measures of governments, financed by central banks. That's a recipe for volatility, ideal for managers like Rubico. Hence, we have done pretty well year to date. More than 200 basis points of alpha, and in RAI terms, good total returns. We also are very positive about global opportunities going forward. We will see much more volatility. For now, we like late cyclical recovery plays like banks, the energy sector, and the next wave of recovery plays will be hotels, leisure, and maybe even transportation. So positive outlook for active management. Thank you very much for your attention and your listening. Please asking questions to the client portfolio managers for war stories on sustainability items, we are really good at that, or credit war stories. Have fun.
Gentlemen, good morning. Thank you for joining us. It's a pleasure to be here with you this morning. I'd like to start with, your more general considerations about, the COVID crisis and where we are right now. So, starting with Reinout. Hi, Reinout. Just your
Morning.
considerations about, the performance of the credit markets year to date, and your overall considerations around the COVID crisis that started back in March.
Okay. Well, thank you and good morning, everyone. Yeah, I think the current crisis is one we haven't seen before. So the rules of the game have definitely changed. We've seen lockdowns of entire economies. We've seen a complete standstill of the entire world taking effect into March. We've seen that in markets. Apart from 2008, I've never seen anything like that in my career. But you do see that as people get more accustomed, even that it's an extraordinary event, and it's not gone yet. It will be with us for a longer period of time, as long as there is not a cure and there's no clear way of circumventing the virus. You do see that people are getting familiar with it, and it's becoming part of life. Me myself living in Europe, we've seen the lockdowns, the gradual opening of economies, people being allowed again to do stuff, and then obviously the worries about a second wave. But within the investment world, you see a similar, yeah, people getting accustomed to this new normal, this situation where things have new rules, and we need to go through that. And what you saw in the market is that initially there was this huge worry. We hadn't seen this before. Markets froze. We saw one of the worst months in history. But what we also saw is once people got accustomed and they said, okay, well, there is value. It was a clear overreaction in the markets. And then people start to look for, okay, what is a safe asset? Where am I not going to lose any sleep over? And initially, you saw some high quality starting to perform first. Some of the US issuers came back to market. Some of the high quality companies paying huge premiums, also to show to the rest of the world is, okay, we're able to issue bonds. And from that point on, you saw that people got a little bit more confident. So dipping their toes into the market. And then there came some relief news, initially from Asia, but also from Europe. And then you saw that people in this world where what we call there is no alternative. The alternative is there, but it's simply in Europe it's a negative yielding bond market, and in the US it's close to a 0% yielding bond market. Is it? Yeah, corporate credit by itself is a reasonably safe asset. There's a huge difference between sectors, but you do saw that people say, okay, let's start to go in, and that is what we've seen as of end of March with the first issuance, and then people slowly starting to get invested again, and you start the market functioning again. You could sell bonds, you could buy bonds, new bonds were being issued, and after one of the worst, or maybe the worst month in the last 20 years, you saw that the recovery also gained speed in the second quarter. And that is, something that has happened. Does that mean that the volatility is completely over? No, because we don't know what the virus will bring. Is there going to be a second wave? We've seen that in Hong Kong. They're now into their third lockdown because things start to pop up. People become a little bit too relaxed. And there are going to be some victims also in the corporate world, especially on the high yield side. Young companies, small and mid cap companies. So it is a big event. So let's not forget about that. But it's also an event with a huge amount of opportunity. So as we've seen something we haven't seen before. So it's always difficult to say, okay, this is going to be the road ahead. But what we do see is that these things start to become a fact of life, and we get around it. And if you do clear, you make active decisions where you put your money to work. We believe at Rubico that there's a lot of money to be made. So yeah, I think that is in a nutshell how we've witnessed the events in the last couple of months.
Thank you. Barnaby, can you share your general views about the equity markets, especially the second quarter performance? And if you could touch on this phenomena we've seen around the outperformance of growth versus value. I guess the disparity has never been this large, right? So,
Sure. Well, we have seen an extraordinary recovery in the stock market in the second quarter. Just maybe briefly touching on the impact of COVID, I'd just add to what Reinout says that there's obviously the human aspect of it, which is horrendous and not just related to COVID deaths, but also the social, economic, and psychological impact on a lot of people. Then there's the economic impact, and I don't think we've really yet we're yet able to sort of get our arms around what that long-term economic impact is. We know that in the short term, it's triggered the most precipitous decline in output globally in anyone's lifetime. But I think the bigger question and the concern we have is just what the shape of any recovery looks like. Because even if we do get visibility on a cure, on an effective vaccine, which we're still no nearer, that there are so other consequences, impact on people's confidence, and just the cost of all that lost output that I don't think it's been fully factored in. Then so in terms of how the market has obviously responded very robustly to yet another round of aggressive stimulus, both from central bankers and from policymakers through fiscal stimulus. I think the jury is still out on whether that market response is appropriate or not. And our view is that it's probably not. That we haven't yet seen the full consequences, and we don't think that policymakers, either central bankers or politicians, can control the direction of corporate profits. And ultimately, that's what will drive equity markets in the longer term. To the question of growth and value, this has been the outperformance of growth is not new. We've seen it for many years now, and it continues. And we've seen it again this year. And I think what that reflects is a very realistic assessment of the challenges that many industries face. There, across the board, whether it's in energy, in banking, in the consumer world, there are so many industries that are facing secular pressures. That it's hard to have confidence investing there, and given the interest rate environment we're in, as Reinout said, we're in this sort of strange world where if you want to invest in fixed income in Europe, you're committed to. If you have a risk in government bonds, you're basically consigned to a negative return. It's forcing up the value of anything that is perceived to have durability. And I think so long as that's the case, we're going to continue to see growth outperform value. The key, though, is what is growth? Because if we're talking genuinely about companies that do have durable growth prospects, they could be bid up to extremely high levels. But who knows? There could be certain companies that are perceived to be growth and turn out not to be, and they will be absolute disasters. So the question of growth versus value comes down a lot to picking the right growth companies.
All right, thank you. Reinout, what about the behavior of credit spreads year to date, especially compared with historical crises, historical events? What are your thoughts?
Well, obviously, March was a huge reaction. As I mentioned before, this is one of the worst, or maybe the worst month I've ever seen in the corporate credit market. Something almost similar happened in 2008 when the month October 2008 was one of those months where essentially an entire market, both in investment grade and in high yield, were completely bidless, as in that nobody was willing to purchase bonds from you. And something similar happened in March. And when that happens, and clients wish to redeem funds from their funds, you see that at some point people run out of liquidity and they are forced sellers. And this is exactly what happened in March. So you saw a huge overreaction. US markets much worse than European ones, and with emerging again worse than developed markets. So you saw a huge gap of in spreads going up, and that leads to ultimately opportunities, because then that is the point whereas what is a fair price for credits. And as I mentioned before, that is when people start to realize that high quality companies, which is, as Barnaby mentioned, companies with growth prospects, solid balance sheets, there is value. And we saw that with the likes of Microsoft, Google, these type of companies coming to market where people know they're very healthy. And they were willing to issue bonds at really high yields. And people see, okay, that is value. So that is the first thing that people step into. As things progressed and more news came out and spreads started to tighten again aggressively in the months April, May, and June, when people got more comfortable with it, central banks had stepped in, policymakers were issuing a lot of fiscal measures at an unprecedented speed, and you saw that spreads came down quickly as well. And it was a bit across the board. So, and also, as Barnaby mentioned, this is not a victimless crisis. So, both indeed on a human level, but also on a corporate level, some companies are not going to survive this. And then we talk about some of the companies which simply run out of liquidity because they had a poor balance sheet management, or companies which were already in trouble even before the crisis because their business was not running great, with less and less demand for their product. The whole situation with COVID-19 is that it speeds things up. So some of these companies are going to be downgraded, or they are going to disappear. So the broad-based rally we've seen in the second quarter, some of it is completely justified, because if your alternative is a 0% yield and you can purchase a good quality company at a really attractive yield, yes, that makes sense. But buying poor quality companies also at an attractive yield, but you don't know if they're going to survive, that is not necessarily that good. So it is really imperative that you make your selection of what is the right companies. Where do I think I want to put my money to work longer term? Is this a business that can survive in the short term because it has the balance sheet to go through this period? But also, is this a company that is, in a going concern basis, a solid company with future demand for their product? And I think, that is going to be crucial, because, as I said, the crisis is going to speed things up. So the good companies are going to thrive, and the bad companies, they will slowly or quickly disappear.
All right. Barnaby, given your focus on managing downside risks, how do you hedge your risks, especially during the current environment with so much volatility?
Well, the first thing I'd say is important to hedge your risk before the volatility comes. And basically there are three approaches we use. The first is own the right securities. So try and focus on owning I think a relatively concentrated portfolio of durable businesses which aren't going to surprise you to the downside. The second aspect is we have a lot of flexibility to hold cash, which we have been using in recent periods. So we have about roughly 40% of the funds in either cash or short-term US Treasuries, which are a sort of proxy for cash. And then the third aspect is hedging. So we do use predominantly we've used put options on a number of equity indices as a tool for hedging against that volatility. That paid off
very well in the first quarter, when the fund was basically sort of flat for the quarter, and a reasonable part of that was those options coming to the money. Obviously, option pricing is not now as cheap as it was back then, so it's become a bit tougher on the derivative side. But we still have a reasonable portfolio of options in place, and we also have some futures to provide protection.
Great. Reinout, you mentioned about the importance of being selective, especially right now. Generally speaking, is it still a good time to buy now? Have we not missed the rally?
Well, obviously, markets have rallied a lot since March. So we went from an exceptional level of spreads to a level which, in our opinion, is still attractive. So we always compare the current spreads, how they've performed in their long-term averages. And what we see now is we're looking at a market which is 1.2 times the long-term average. So at longer term, we say, yes, there's still tremendous value. There's going to be large differences between sectors. As some of the sectors have already treated much more expensive, so things are being priced in. Some of the sectors still look relatively cheap, and some other ones, are cheap, but again, are cheap for a reason. So it is getting the selection right, and also, as Barnaby mentioned, it is also a little bit about making your positioning a little bit more dynamic in these times. So when we went into the month of March, we had not that much risk on board in our portfolios. We had quite a bit of cash, which we can hold. And then when the volatility comes, you don't need to look for liquidity, and you put it to work, and you put it to work in something that is really cheap. And what we've done in the second quarter, as the market performed, we've taken some profits here and there. And you start to build up a little bit more cash, and you let the risk of the portfolio reduce a little bit, to make sure that if again there's a good chance that there's going to be more volatility down the road, because it is so difficult to predict what will happen, where it will happen, how people will respond, how long it's going to take. So is there going to be volatility? Absolutely. But we think longer term, even if you invest now, and especially if you invest in someone that is active, there's some really good value to be made. And we think the prospects for returns in the second half of this year are going to be really well. But you do need to remain selective.
All right. Barnaby, emerging markets is a region where you have an underweight, right? Is this a more structural thesis, or is it more related to the COVID crisis?
Well, it's certainly not related to the COVID crisis. I mean, our positioning in our fund does not change that much. I mean, it's we've held many of the positions we've held for several years, and so we don't sort of change positioning sort of tactically quarter by quarter. The reason, I mean, you're right, we are pretty underexposed to emerging markets. I mean, we have a bit more exposure than it first looks, because we hold companies, particularly in the consumer staples areas, companies like Nestle and Beiersdorf, which I think do half of their business in emerging markets. So we get access indirectly, so to speak. But you're right, we don't have a high exposure, and I think it really comes down to our obsession with understanding the downside and understanding the risks. And I think in general with emerging markets, the upside is probably higher, the potential is higher, but implicitly it's a higher risk region. You have a whole layer of risk around economic, political risks and currency risks that just make it very difficult to sort of know where your downside is. And our general experience has been that where we find really interesting businesses in emerging markets, they tend to always trade at quite high valuations. And where we find very cheap valuations, there's usually a good reason for it, and they just don't meet our quality criteria.
All right. Reinout, thinking about a matrix between valuations and allocation for corporate credit, Do you consider the market right now as overbought / overvalued, or the other way around?
It differs really per market. I think some of the markets look a little bit expensive. As I mentioned, as people got more comfortable with the crisis and more news came out that things were opening back up, people became sometimes a little bit too opportunistic. And then especially if you look at, for example, within the high yield market, the lower rated part of the market, you saw a lot of opportunistic buying. And we think, yeah, the default risk is simply too high at this point in time. These are small companies, there's no support. We think that is getting expensive. Certain parts of emerging markets, they really caught a bit in June. That is looking fairly expensive. And then we think, yeah, some of these companies will struggle because, yeah, the fiscal room within emerging market is simply less than it is in some of the developed markets. Developed investment grade, we think, yeah, still looks interesting. Certainly there's a difference between some parts of the other one, but it is the highest quality part of the market. There's a high support from central banks and governments at that particular part of the market. So there's going to be a little bit less volatility in that part. But even there, you can see that some of the names are already trading at similar spreads that they were almost at the beginning of the year. Some of the other ones look attractive and other ones don't. It's really, you do have to be flexible. I think, within investing in credit is much less about multi-year thesis on how corporate profits are going to do. It is also, a little bit more tactical. So some of our trades are really long-term because we think a company is in transition and you can make a lot of money. But at these times, it's also about being flexible, being able to move into this industry because the risk return is simply the highest. And once it has played out, you need to move into other parts of the market where you get a lot of excess return compared to the risk you are taking. That is simply, what we do really on a day-to-day basis is with our analyst team, look for those best opportunities. And we think, there is still really good value.
Barnaby, what does a great stock look like for you? And can you illustrate that with some examples or one example in your portfolio?
Sure. I think the best definition of a great stock is it's something you can buy and then go sailing around the world for 5 years, not worrying about it. So the key for us is just owning a company with really durable assets and cash flows, and buying it at a valuation that you feel comfortable with. I'll give you a couple of examples, and they're both large positions in the fund, and they're both quite different, which I think it makes them interesting. The first is Costco, which many people will be familiar with. That's the discount warehouse-based retailer. 70+% of its sales are in the US, but it has now moved into about sort of 14 or 15 other international markets. We've held this stock for a long time and probably will hold it for a very long time because it just has all the characteristics that we're looking for in terms of the time frame that management use when thinking about running the business. They think in decades. They don't think in quarters. They invest behind the business. They don't seek to maximize near-term profitability. So, give you one example. The way that Costco works is that essentially customers have to pay a subscription, a membership fee to be able to go into Costco, and that forms the bulk of the company's profit. They barely make any profit selling merchandise. They sell it at as low a price as they possibly can in order to maximize value for their customers. And they have a fantastic value proposition, both in terms of price and quality. Typically what they're selling is 15-20% cheaper than where you can get it anywhere else. They could raise the price 2 or 3%. I don't think customers would notice, and the profits would probably double overnight, but they would never do that because it's just not in their mindset. So, and similar to how they manage the balance sheet. So that just gives us a lot of confidence that this company is going to be around and growing and and not see its profitability impaired, looking out 5 to 10 years. The other example I'll give you briefly is a German residential property company called LEG Immobilien, which is actually our largest position, and probably many people haven't even heard of it. But this is a very interesting area for us, German real estate. It's one of 3 German real estate companies we own. And essentially, the real estate market in Germany is heavily regulated, which puts a cap on what companies can charge for rent. And what that means is that both rents and property prices are really below where they should be in a free market. So to give you some color around that, LEG, which owns about 150,000 apartments across central Germany, its portfolio is valued at about 1,200 euros a square meter. Just build costs, if you just had to build its portfolio again, would be about 2,500 euros a square meter, and that excludes the cost of the land. So when you're looking for an asset that is if you've got an asset that's trading so far below its replacement value, where cash flows are growing gradually 2 or 3%, so more revenues growing 2 or 3%, cash flows are growing 5 or 6% every year, and it's spinning off a dividend of close to 4%. As Reinout says, you're not going to get 4% anywhere in the German Bund market, and you're going to have to take quite a lot of risk to get 4% in the corporate credit market. Here you've got a dividend that's growing with inflation at 4%. So that's very attractive.
Great. Reinout, why is Rubico Global Credits different compared to competitors in the space?
Yeah, I'm not saying that we are completely unique, but I think, within Rubico, there's a strong belief that we'd like to take risk, but we want to make sure that we're getting the proper reward for taking the risk. So we have a clearly defined philosophy and strategy where we try to exploit behavioral biases by a purely research-driven investment strategy. And so if you look at our process, it is fairly simple. So not that many bells and whistles, no highly complex models, etc. What we do is we look at the world top down. We look at what is the overall valuation, what is the state of the economy, and what are central banks doing, what are investors doing, to see how much risk we want to take overall. And then secondly, we do a lot of bottom-up research. So every company we own has been researched by the team. So we have a very large research analyst team that is continuously looking for what are the right companies to invest in, and also look at if the amount of yield we're getting to be invested is sufficient, that matches the risk profile of that company. And then thirdly, I do think that has been unique, and I think it is getting more common nowadays, is we've been doing a lot of ESG research. We've been doing that since at the beginning of this millennium, and we've always been developing that. And that is something to us is still a clear differentiator, because it's not something that is just identifying which company is doing poorly for the environment, or which one is doing well, or which one has the right governance. To us, it's about getting more information that doesn't necessarily show up in the financials of a company. So if the governance of a company is very poor, it becomes harder to assess what the risk is you are taking. But it's also about getting information on the long-term prospects of a company. And you see that happen all the time. We've seen that basically last 2 years with a company like General Electric. You see they are large in coal-fired turbines for electricity producers. And you see there's a lot of resistance against using coal as an energy source. And you see a company like that, their portfolio is in decline. They get less orders, they get less profits. So for us, that entire framework is getting that extra bit of flavor, knowing the company, getting to know a little bit more about the long-term prospects, and making sure that you are no longer invested way before actually the event happens that an asset becomes obsolete or or something else, or a governance issue comes out. So I think that is something we use all the time, and it has really helped us to make sure that the performance we make is consistent.
I'm glad you brought this up. Barnaby, can you discuss a little bit your focus on ESG, and especially how do you incorporate that in your portfolio, your valuation models, your recommendations?
Sure. Well, I agree with Rinard. I mean, I think it's a critical part of it should be a critical part of anyone's investment process. And I think the longer your time frame, the easier and the more logical this becomes. I think if you're investing on a 1 or 2 year view, the financial implications are probably pretty limited. But if you're investing on a 10-year view, then they become much more material. And as I said, I mean, we define a good stock as being one you can buy and put away and forget about for 5 or 10 years. And if you've got that time frame, then you absolutely need to be considering what the social and environmental externalities of a company are, because I think those impacts have always been important. And we can think of plenty of examples of companies that have tried to cut corners in terms of how they treat their workers, how they treat their suppliers, how they treat the environment, and that they've ended up suffering for that. And I think in the next 10 or 20 years, that's going to increase dramatically, because I think that the whole societal and political focus on this, on capitalism generally, is only going to intensify. So companies that have thus far not borne the cost of their social and environmental impacts, I think will do in future. So it's just part and parcel of our investment process. I mean, the first question we ask is, what does this company do, and how does it create value for its customers and for its stakeholders more broadly? And if we can't get comfortable on that, then we just wouldn't own it.
Great. Right now, changing subjects here. Do you consider the Fed, ECB, other central banks' interventions as appropriate? What you have done differently?
Well, it's very easy to sit on the sidelines and say how they should have done differently. I think from the way we see it, I think the swiftness of the response, I think, was very appropriate. And there you see that they've learned from the previous crisis. So when we looked at 2008, central banks were extremely slow in responding to the market environment. Political leaders were very slow in responding, especially here in Europe. I remember in 2008 is that Mr. Trichet was still increasing the interest rate in October 2008 when the whole world was falling apart. And it took European leaders forever to get fiscal measures into place. So what we've seen now in March is that people have learned from it. They took swift action, and they've made sure that things didn't completely fall apart, as we saw in 2008. Can you criticize the central banks and governments? I think there's definitely something that we think, central bankers definitely tend to forget, is that, and Barnaby already mentioned it, is a central bank does not drive corporate profits. They provide liquidity. And so ultimately, longer term, the world is driven by corporate profits. How effective can we run a business? How much demand is there in total? And that is something, and you often feel that central banks have lost that sense of reality. We see that here in Europe as well, where government bond rates are negative. And then people are surprised that the population is actually saving more instead of investing more. And that is because they can't make a decent return on their government portfolio. So they need to save more for once they go into retirement. So instead of spending, they start saving. It's these little things where we think that central bankers need to watch out. But I think in a crisis such as March, I think being swift and being you're ready to make bold moves, and I think that is something they did, and did avoid a total collapse, because that is ultimately what you want to avoid, and that is something they definitely learned from 2008, when money markets completely froze, and we almost reached the end of the system, or at least the financial system. Yeah, I think that was really necessary. So we're happy about that.
Barnaby, on this subject of monetary and fiscal policy, what are your main considerations and especially implications for the medium term, right? Do you think we're going to see a higher inflation environment in the next few years? What's going to happen, with the US dollar and implications for equities?
Sure. Well, firstly, I'd agree with Renaud that in the crisis phase of March this year, it was entirely appropriate to see such aggressive monetary and fiscal reaction. I think the problem is that if we take a step back, this has been going on for far too long, and it's been going on in a one direction way only. So there's an old saying, to a man with a hammer, every problem looks like a nail. And you feel that with central bankers, the only tactic they feel they have in their armory is just cut interest rates or inject liquidity. And they're very reluctant to go in the opposite direction, and have been for many years, and very keen to do so quickly when the opportunity arises. And I think we've created other unintended consequences of problems as a result of that. I think negative yielding bonds is just an abomination, and it has corrupted so many aspects of the financial system. Where you asked us of the $1 million question is, when does all this sort of translate into inflation? And I think the answer is inevitably at some point it has to. I think what we've learned is that monetary policy beyond a certain level actually becomes quite impotent in terms of driving behavior in the real economy. What it's done perversely is driven financial markets higher, which I'm sure was not the intention of the authorities when they first stumbled upon the idea. But clearly, now that the fiscal levers are being pulled, eventually, I think it is inevitable that inflation picks up. But the challenge, and I don't have an answer for this, is figuring out the timing of that. And then the other question to bear in mind, you asked this, is in an inflationary environment, what are your inflation-proof assets? Are equities an inflation-proof asset? I would say the jury is out on that. If you look at the last period of high inflation in the 1970s, they were anything but an inflation-proof asset. I mean, the S&P delivered a flat to slightly negative return in nominal terms during a decade where we had consistent 15+% inflation. So in real terms, it was a horrendous investment. So it's hard to know where to go it's hard to find an asset class. There are distinct individual assets, but an asset class that provides real inflation protection, I think, is next to impossible to find.
Renaud, going back to the spreads discussion and where valuations are, you did mention that variance between different sectors, right? We've seen earlier in the crisis, the energy sector spreads, for instance, widening significantly. Right now, do you see, in terms of sectors, where do you see most opportunities, and where do you see things are extremely overvalued right now?
That is a good question. Where do we see value? So we see some value actually in the energy sector. So with oil prices dropping below 30, you saw that energy companies, the profitability declined rapidly. And you see that longer term, the demand for oil and energy will remain. So yes, there's a temporary decline. We do think that it will pick up, and a lot of these companies will be a decent investment going forward, especially on the credit side. There's a part of the energy market, like the US shale market, we're not so enthusiastic about, and that is because it's a very expensive way of getting oil out of the company. It's highly controversial, which we think at some point might see a reversal there. So it is not the entire energy market, but energy as an asset class is to us, from a fixed income perspective, is attractive. We also see some value in parts of more cyclical industries. So the market there is still pricing in, for example, car companies, but also the more cyclical consumer goods that, a lot of these companies are going to be in trouble for a very, very long time. We think some of the companies are actually looking very attractive. So yes, it might take a longer term before corporate profits really go up again. But again, from a fixed income perspective, once we get stabilization and visibility, that is already sufficient for that market to perform. And I think thirdly is one part of the market that we think is attractive is still the banking market. So you do see that banks are being hit by the crisis because their non-performing assets will start to increase. But what you do see, and that is something where central banks can actually make a difference, is that they can provide them with, first of all, very cheap liquidity, but also on the capital side, they can give them relief and actually temporary breaks in how to assess their balance sheet. So, and people are very cautious still on the banking system, simply because the last crisis was a banking crisis, so people are very cautious when it comes to banks. From an equity point of view, given the low rate environment, it might not be that attractive. I leave that to an equity investor to give a final say there. But you do see that the return on equity in the banking space is modest. But from a fixed income perspective, we are not looking for that enormous return on equity. As long as it's healthy, it is good enough. Now, are there parts of the market that we're less comfortable about? Yes, so some of the highly cyclical industries, transportation, certain parts of leisure, we think ultimately there is money to be made there, but it's further down the road. So I would be a little bit cautious. Going into lower rated assets of highly levered companies, I think that is a very risky strategy, and I'm not entirely sure that you get paid for it. And I would also be, we're very conservative when it comes to the emerging market assets. We like large companies which give a lot of transparency, which operate internationally, decent companies, but the companies that are really focused on local markets, they tend to be more vulnerable, and there's less visibility on where that is going. So that is part of the market that we leave. And then on the other hand is the really high quality part of the market that has already performed. It is fine to hold as a base investment, but it's not going to bring a huge amount of alpha anymore. That is simply market return that you get. And we think, most of the pure market return, that was the second quarter.
All right. Barnaby, and given what you said, you look for in stocks, and you gave us two good examples, and given also your agnostic nature relative to indexes, right? Can you discuss a little bit your sector exposure, which sectors you like the most and which sectors you don't like right now?
Yes, certainly. I mean, the first thing to say is we own about, I think, 30 stocks in the whole portfolio. So we're pretty concentrated, and we buy companies rather than sectors. So that's just to be clear. But if you look at our exposure, and particularly comparing it, thinking about how the broader benchmark looks, where we tend to find opportunities. I've mentioned real estate. I mean, that's and it's specific to just German residential real estate. So it's a very niche area, but that alone is about 8% of the fund. And obviously it's an inconsequential part of the benchmark. Consumer staples, we have a reasonable exposure to. It's about 8% of the fund. And there it's just, we like the fact these companies tend to be, very sticky, durable businesses that, sell things that people buy week in, week out, and have, very long duration brands. And then the other is technology, which ironically is an underweight relative to the index, but it's our biggest single exposure. We have about 20% of the fund in technology, and that ranges from, we have quite a lot of exposure to software businesses, also quite a lot of internet exposure, and some technology hardware. So areas that we don't have any exposure to. I mean, energy would be one. We have almost no exposure there. And again, maybe and banks would be another big one. And I suppose both sectors that Renaud mentioned. But I think to his point, from an equity investor's perspective, we are looking for companies that we think can deliver, can outgrow the economy over time. And I think in both those areas, we struggle to find. Struggle to see that. And then the other area which may be of interest to people is healthcare, which we'd like to have more exposure to healthcare because in some ways it has a lot of the attributes we like, in that demand for healthcare clearly is very strong, and it it grows better than GDP over time, and it's very defensive. It's not sort of it's not contingent on the economic environment. The problem we've found is just looking at the big constituents of healthcare, it's very hard to get confidence in the sustainability of the pricing environment, particularly in the pharmaceutical industry, where frankly there's a degree of price gouging in the largest market in the US that we worry will eventually come back to haunt these companies. So we don't have much exposure there.
And we did discuss, growth versus value, right, earlier in our conversation, and you did mention exposure to tech. Talking about, the U.S. mega techs, right, mega caps. So the FAMG. Basically, I think their earnings probably doubled in the past, 5 or 6 years, but valuations increased fivefold probably, or fourfold during these past 5 or 6 years. So P multiples, really expanded, right, for these particular group of stocks. Did investors completely lose the regular, valuation methodology references, or is this, well justified by the current interest rate environment and how these companies are consolidating each market? So do you have, some considerations about these US mega caps?
Sure. Well, let me answer that in a few ways. I mean, firstly, just to clarify on the growth versus value, I always think that every investment comprises a bit of growth and a bit of you want to find a company that can grow and buy it at a value that's attractive. And that's maybe a statement of the obvious, but I think it's important to keep that in mind. So we're always looking at things through both those lenses. In the case of the sort of mega caps, the mega cap techs in the US, we tend to group them all as one, but actually they're quite different. I mean, so if you take, say, Amazon and Netflix, in both of those cases, the struggle is valuation, where they're trading on huge multiples of current earnings, and so you have to make this heroic assumption about what the future growth has been, and we're just not good at that. It's not our scope. I mean, I wish we'd owned both of them. We haven't owned either of them, but they've been fantastic stocks. But we just have never been comfortable. We always looking for a margin of safety from valuation that those companies have never been able to provide us. With Facebook and Alphabet, in those cases, it's slightly different. Actually, the valuations don't look too extreme. We have in the past owned Facebook. We actually now only own Alphabet. I think the concern there is more around, well, firstly, there's a shorter term cyclical concern in that these companies now are probably the biggest sources of advertising spend in the world. So advertising is cyclical. And we're in the midst of a pretty sharp economic contraction, which we think could go on longer than people think. That revenue stream is likely to be much more cyclical than it has been in the past. And the other big question for these companies and for the big tech companies more broadly is just the extent to which politicians and regulators will allow them to remain as powerful as they are. I mean, at the end of they are phenomenally powerful companies, both from an economic standpoint in terms of their business models, but also just in terms of their influence on society. And we live in an era where sort of companies rule the world, but the reality is companies don't raise armies or have police forces or have rule of law behind them. And if you look going back through history, large corporate ambition is eventually reined in, and that is a concern. The final thing I'd say, Renato, is on those big mega cap techs is we've seen huge flows going into passive funds, into ETFs. And I guess one question, and we don't know the answer, but we suspect a significant part of those stocks' performance has just been the strength of those flows, bearing in mind what a big constituent they are of passive flows generally.
Great, thank you, gentlemen. It was a great pleasure having you with us. Thank you so much. It was a great conversation. Renaud, Barnaby, again, thank you.
Thank you.
Thank you very much for having us.
Corsini.
Renaud, Barnaby, thanks for sharing your opinion and your time with us today. Obrigado, Mimica. E obrigado a todos vocês que nos acompanharam hoje em mais essa live. Lembrando que amanhã, dia 25, encerramos a nossa conferência com o tema Tendências Globais após o Covid-19. Muito obrigado e até breve.